In today's market update, we have the usual. We're checking in on the stock market, the state of the consumer, and the strength of the U.S. economy. But in addition to that, in Rapid Fire, you don't want to miss. We answer the question, when's the best time to invest? Let's dive into it. Now, before we get into the market update, just a reminder to like and subscribe to our page. We're getting close to 2,000 subs and we appreciate that. And our Instagram and brand new Facebook page. If you haven't had a chance to check those out and like those pages, we appreciate it very much. Well, I cannot believe it, but we are now heading into October, 3/4 of the way through the year. And for the stock market, the big story year to date, you can see the chart this year so far, the big story was the over 20% sell-off that we had in the spring that was around the tariffs and the trade wars. And that caused a lot of volatility in the markets. We did a lot of videos during that time. And the real key then was that a lot of economists thought that a recession was a foregone conclusion at the time. And we came down the camp that said, no, we think the consumer is still doing strong enough and consumer spending is a large part of the economy. Plus, and we came and gave you basically live company earnings reports where companies were saying, hey, we are not seeing a weakening of the consumer. And so what we have seen in the last 4 or 5 months, you can see there the market has kind of steadily been going higher, powered in part by company profits growing at a much faster clip than what was expected going into each of these quarters. Now, we have 3 months left, and there's 2 quick charts I want to show you here. And look, any year things can come out of left field that are unexpected, so keep that in mind. But this first chart takes a look at the stock market over the last 20 years, and you just take the average of how it does over the course of the year. In red there, late September, early October, where we are now. And notice, after historically we get a sell-off in September, that did not happen this year. But notice late October, November, December is normally very good for the markets. It has been that way most of the years here in recent times. So listen, we believe that the markets can finish higher than where they are today. This chart kind of backs that up. But we have another one also we want to show you. And this takes a look going back to 1950 at occasions when the stock market is up 10% or more through the first 9 months. That's where we are this time around. And in October, the October return, there's some red numbers in there. October's not always a positive month. But on the far right, Q4 return for the period of October 1st through December 31st, noticed on average the market's been up 4.3% and it's been higher 80% of the time. So I'm mentioning this because there's some investors who think, hey, the market's doing well. Does that mean I've missed out on the gains? This chart tells you that that is not the case. Typically, there's more gains to come. Now checking in on the state of the consumer and the U.S. economy. In our last video, we had just gotten the news that there had been a negative revision of over 900,000 jobs for the year ending in March of 2025. And we said this is the second year in a row we've seen a big revision. Also, the previous 3 months, jobs had been revised lower also. And we said this is leading a lot of people to ask the question, is the jobs market in a very bad place here? We said when you took a deeper look, and you can go back and watch the video, the answer was no. Since that video, the most important data around jobs that there is, initial claims for unemployment insurance, and this we get weekly from the state, so it's a lot more reliable. And you will see last week, and we're filming this again on September 30th, Tuesday, so the previous Thursday, Initial claims came in at 218,000. You can see just a few weeks ago, this was up above 260,000, which in of itself is not that high, but it was one of the higher numbers in the last couple of years. So it drew some people's attention. But take a look at what's happened since. The bottom line here is that companies just are not laying off workers. This is exactly what we said we needed to see as we came into the fall. That's typically a better time for the jobs markets. The first jobs report for September is going to come out on this upcoming Friday. So we'll see what happens there. We'll post something on our Instagram and Facebook page about that. But this is good news here that the layoffs number is so low. Next, we just got new data on retail sales, and that is consumers going out and spending money. And you can see this came in year over year at 4.77%. That's up near the highest level in the last 3 years. So, and again, that is on the rise over these last couple months. So consumers spending money. We had heard that this was happening from Visa and MasterCard and American Express, but it's always good when it reflects in the data as well. Now, those are two individual data sets. We're going to now look at two very important GDP updates in our late August report. We had talked about how second quarter U.S. GDP numbers had come out at 3% growth. That was great, but it had been revised higher to 3.3%. That was the first revision. Well, we have since got the second revision, and it's now up to 3.8%. And if you take a look there over the last couple years, last 3 years, this is a quarterly number. 3.8 is the second highest growth rate in that time frame. So this was important because remember in the first quarter we got a negative number because there was so much more imports being bought than what we were exporting here to try to get ahead of the tariffs. That caused the number to be minus 0.6, you can see there, but the 3.8 was a great bounce back. But still there were people who wondered, hey, is this a one-time thing that we're going to get this bounce back? Well, we just got an update from the Atlanta Fed for the third quarter. That's the quarter that just ended here. They are predicting a 3.9% number. And this was just 3 in late August when we did that update, now up to almost 4. This is really remarkable that we could be looking at back-to-back quarters with near 4% economic growth. That is good news for the markets because again, when the economy is growing, get that strength, normally corporate profits follow as well. Now for rapid fire. And this is where I go over key charts that I think you need to know about. And we start off by answering the question that oftentimes I get asked, which is, hey, is now a good time to invest? And sometimes it's a young person talking to me, and sometimes it's a senior citizen and everybody in between. This is pretty remarkable. This takes a person, and the numbers don't matter so much, the annual numbers invested, but this is taking a look at somebody who is saying, hey, look, I'm going to invest $2,000 a year. I'm trying to decide when do I do it. So you can see, and this is over the last 20 years, the person on the left, perfect timing, they invested at literally the lowest point the market was at for the calendar year. I'm pretty sure there's no one who has that crystal ball and is able to do that, but let's just say you were able to, you would have $186,000 today. Now, right beside that, invested immediately. This is somebody who invests the first day of every year and they take that money. Notice, it's not that much less that they have at the end, $170,000. They're still doing very, very well. Next up, dollar cost averaging. That is somebody who at the start of each month just invest in equal installments all year long. They have $166,000, again, fairly close to these other numbers, or at least the invested immediately at the start of the year. Then we take a little drop. This is the person who has bad luck / timing. They invest literally at the high point of the year. And jokingly, I have people who mention to me, hey, if I invest, the market's going down, my timing's terrible. Well, even if that's the truth, every year that's the truth, that person still has 151,000. They've still done pretty well, albeit not as good as these other time frames. And then lastly, sitting in cash. And actually, I should mention, this is sitting in treasury bills. If you truly had the money buried in the backyard or under the mattress or sitting in a savings account at a bank, you have much less than even this 47,000. But nonetheless, take a look at the difference here. Even if you have the worst luck on planet Earth, you still have 3 times as much money as your account as if you had just stayed in treasury bills instead. So the point is, time in the market is far more important than timing the market. I thought this chart did a good job of showing this. And one other thing I want to mention while I'm on this is, just a few months ago, we started a new series called Finance Uncomplicated, and episode 1 was on budgeting. And again, it was geared to people of all ages. It was based off a workshop series I did for over 100 companies throughout Atlanta, Metro Atlanta, for over a 10-year period, and it worked for people of all ages and income levels. You can go back and check out the budgeting video if you want. Next week, we will be publishing episode 2, which is Investing 101. In there, a key section is common investment mistakes that I see, so make sure you are on the lookout for that. Now, the next chart here, we are looking at GDP growth. We talked about that earlier, but this time around, we're breaking down the growth by AI, IT equipment and software investment, and everything else, because there's this narrative out there that says, hey, all the growth in the economy is coming from AI, everything else is struggling. And take a look, and what you'll see here, this is quarterly over the last couple years, and in black is AI's contribution to growth, and blue is everything else. And look at the quarter most recently that we just got, and notice that there is a whole lot of blue there. And we had the negative number in the first quarter, but like we talked about, that's because of how much more we imported versus what we export. That's not what matters most here. The key theme in this chart is that the blue growth has been consistently strong over the last couple of years. Black is we are going to see that rise in the years to come, because we know that for the big tech companies, they are already seeing the AI expenditures pay off in form of higher revenue and higher profits. But we like to see this. This lets you know the markets can have a broader rally because it's a broad-based GDP growth. All right, the last chart in rapid fire here is taking a look at earnings revisions and the ratio. Basically, here's the key point on this chart is it takes a look at every time an analyst raises expectations for profits for companies versus when they lower them. And what you'll notice here on the far right, this is at the highest level in almost 5 years, meaning, and you see this has been rising significantly in the last few months, meaning that analysts are consistently having to raise estimates for corporate profits right now. This is something that we've talked about, and we've shown other charts showing this trend all year long. But this is the first time we've shown this specific chart. And like we said, if you go back and look, this is over the last 30 years, the times when earnings revisions went up this much, typically the market did really well following those rises. Okay, so the key takeaway is that the stock market has had a good first 9 months, but you had to get through a significant sell-off earlier in the year. That's what clients have us here for, to help them do. And we had to do the work that said, listen, a recession is not imminent at the time, even though most economists believed that it was the case. The other key point is, even though the market's up over 10% so far, we're entering typically the best time of the year for the stock market, so there could be more good times ahead for stock values. Now, if you are new to Centerra Capital, you can head on over to our website and go to the contact page, reach out to us. I recently brought on a new client who told me that they had not heard from their previous advisor in over a year and a half, not so much as either an email, call, anything. If that is you, and we know there's a lot of people out there like that, please give us a call. We'd love to talk to you. We have a 3-meeting process to see if we are a good fit. Well, thanks for watching and take care.